Hello guys, welcome back to my YouTube channel Learn with Pep. And in today's edition, it's not the regular. I have with me a very well seasoned professional. We have IWELABI with us on this particular episode, and he's going to be talking about every single thing you need to know about IFRS 15. So stay with me and make sure you have your jotting pen and your jotting pad ready, okay?
Hi, good afternoon, IWELABI, or how do you want to be addressed on this call? What do you think we should call you?
Yeah, no, it's fine. IWELABI is fine.
Okay,
No, IWELABI is just fine.
good to have you on the call. I mean, before we go in depth, there's been a question on my mind. I really want to find out, how did you come about the name IWELABI? Like, I don't know. How did you come about that name?
Wow, interesting. Okay, that's actually an interesting question, right? I think the moniker IWELABI to me came about when I was in school as an undergrad. And so the whole idea was that I kind of have a very, should I say, obsession for like reading. Just, I'm like that boring guy, and so everything that I just do just circle around one thing, which is more or less like on education and stuff like that. So there was one day, when I was in school, I used to carry my bag up and down. Like anywhere you see me, you literally see me with my backpack, right? So people, apparently some people have been observing that. Like, if I've had people tell me that there is nowhere, no day I'm seeing you are with your backpack. And guess what? It's actually something that is happening even right now after I left school several years ago with my system, with my work too. So anywhere anybody sees me in almost any pictures, they are seeing me with my laptop and stuff like that. So how did we come about IWELABI was that there was a time during my undergrad, and then I used to carry my bag all about, and I wanted to pray one time like that, right? And I carried my bag into the ablution area, like, and then somebody was like, this brother is just IWELABI, like, he's just
all about the books.
Like, this brother is just obsessed with book and reading and stuff. And guess what, right? Guess what? It is actually funny. When the guys, it was when it became apparent to me, and then I kind of like it, and I, like someone grew up on the island. And as a conscious individual, right? At first, I was kind of scared to say I want to be using that nickname, IWELABI. I was kind of scared. Why am I scared? Because I know that people will have a lot of misconceptions about me. Yeah. People will think I'm proud, think I'm this. People will think I'm that. But I was really scared, and I don't use the name. I don't use the nickname anyhow. Then I got to start using the nickname much more. I got confident to use the nickname after like I left school, and I was doing my ICANN and stuff like that. How did I start using the nickname more comfortably was that because of my background, I grew up on the island, Lagos Island, and island notoriously known for hooliganism, right? And so there was a time during some of the Friday sermons or stuff like that that we usually have at the mosque, and then the ustaz was like, there are some people on the island, their nickname is Botu, like Igu, their nickname is Iku, their nickname is this, and then the ustaz was not trying to pass the message that whatever your nickname is kind of resonates with how you live your life.
Yeah.
Right? Oh, okay. When I had that stuff, I kind of feel like, okay, interesting. So it was more like being an islander, I wanted to like the difference, right? Like the common thing you find around is, in fact, people call themselves marijuana, Igbo, this and that. And then, so I was not like, if those ones are proud to call themselves or address themselves with stuff, then why am I shying away from being addressed as IWELABI or recognizing myself as IWELABI, because I was so scared, to be honest. I was so scared. Then Then the next thing is I started using it just little by little within my guys that know me. And just like almost every other person, we are all one way or the other scared of what is people gonna say, or what are people gonna say about you and stuff like that.
True.
Until you become so conscious that, guy, you can't live, you can't move forward by just worrying about what people are going to say about you, right? You just have to be yourself and then move on. And that's how I started, like, being myself. And since I started using IWELABI, the journey has now been trying to live up to the name.
Like,
It's
I was
actually
going to
fun.
say that, because if you're calling yourself IWELABI, it means that like
Exactly.
you have to live up to
That you
that
said,
name. You have to live up to
yeah.
that name, actually.
Exactly. So knowing that I've kind of been, like, as much as possible trying to live up to that name is now something like I find really, really impressive. So when people say, or when people expect that IWELABI, you must know it all, I'm like, nope. The meaning of IWELABI is somebody that continuously learn. I'm a lifelong learner, and that's like the way I see being an IWELABI. Or in fact, that's actually how the IWELABI of a thing started, because people always see me like, this guy is just always obsessed with learning and development and stuff like that. So that's it.
Really nice. I'm sure a couple of people that, a couple of, what's the right word now? Will I say aproko people like me would have thought about the idea behind that name, because I kept wondering, like, how does someone wake up one day? Is it that your friends, or did you grow up and people grow up calling you that? But it's so good to hear the backstory. So good to hear the backstory. Okay, guys. So on the call with me this afternoon is IWELABI. His name is actually Qudus Adebowale. He's a chartered accountant. He's actually one of the top guys. Like I said in our post, to be tutored by IWELABI, it's a privilege. I'm not even going to lie. Like, I've heard so much about him. I've even spoken to him before now. Like, he tutored me on something and it was really, really good. So yeah, guys, we have IWELABI here. He's currently a co-founder of Mentorship Corner. I'm sure a couple of you know him from that side. Then he's the head of finance. So whatever it tells you, just take it as it is. He's the head of finance at Tutor. Is really, really good. And we are so happy and so grateful to have you on this call this afternoon. Welcome on board. Please, you have the floor.
Thank you very much. I'm really glad and privileged to be here as well, right? And I feel like just like almost the way I used to say every call I am on, we are all work in progress, we are all learning. And then, like, the most important thing is just for you to be flexible with your knowledge, most especially when it comes to accounting and finance knowledge, because when it comes to accounting and finance, it is actually very broad. And you can't be someone who is so adamant that this is the only one way to go. I think as much as possible, you have to be flexible, and you have to know that there is no one way or one size fits all when it comes to accounting and finance, because as we all know, as finance professionals or accounting professionals, we record and report situations, right, in number terms. So, and situations can always be different, right? And when situation is different, definitely there are instances where the approach to resolving those situations or addressing those situations are also definitely going to be different, right? So today we are going to be looking at the one thing, or one of the most important thing to every business. In fact, if not the most important thing to every business out there, that one thing that regardless of where you work, regardless of whether it's a big company, multinationals, small company, startup, medium company, or even the Namina U companies that we used to say, right? Regardless of the kind of company you're working, you are going to have to know this particular topic we are going to be discussing, which is on IFRS 15. Revenue from contract with customers. Revenue is something that everybody, regardless whether you're in the private sector, public sector, NGO, regardless of where you work, you just need to know revenue. You must know revenue, because for every company, most especially every profit-oriented company, right, there is a need for revenue, right? Even at some point, for companies that are not for profit, they still have something that it relates to revenue, which
Yeah.
is like their sources of
Subscription.
inflow.
Yeah.
Exactly, all these inflows and stuff like that. And then the funniest part is that this revenue, right, before I delve into IFRS 15, there is the part where some people call it income, some people call it sales, some people call it revenue, and then we see students kind of fighting and then trying to know what is the difference between all of these things. All of these things are
Some
things
call
that
it
we are going.
turnover.
Yeah, some call it turnover. Interesting. And trust me, by the time we delve into this session, I think we'll be able to like tell us whether they are the same or not, and if
Okay.
they are not, what the differences are looking like. Right.
Okay.
Yeah, but then let's go ahead and get to IFRS 15, right? Revenue from hold on, just give me a sec. I'm trying to share my screen.
Okay, that's fine.
Oh, can't share my screen.
You can't?
It's yeah, I'm trying to do that. Just give me a sec. Okay, I can now.
Okay, perfect.
Can you see my screen?
Yes, I can see it. All right.
Okay, interesting. So we are going to be looking at IFRS 15, revenue from contracts with customers, and I'm going to be very brief with my introduction so that we can go into the main work. Again, this is the topic of this particular session is IFRS 15 in the workplace, revenue recognition in the workplace. How do we go about recognizing revenue in the workplace? And I want to believe that this video is going to be useful and prove valuable to everyone who is going to be watching this now and later in the future, as we delve into aligning the theoretical concept of the standard to what we are doing in the practical world, right? So
Okay.
revenue, IFRS 15, revenue from contracts with customers. According to IFRS 15, right, which is like the standard that guides how we recognize revenue. I'll kind of be brief with my intro around this subject matter.
Okay.
The standards on how we recognize revenue on any form of engagement that we are getting into as a business or even as an individual, if at all you want to start recognizing revenue. The standard has something very, very important that you need to fulfill before you can say that you have recognized revenue. And why is this? Is because when there is no standard, people can just do however they want and then just claim whatever they want to claim as revenue, right?
Sure.
So let's get to it. The standard says that for you to recognize a revenue from a transaction, for you to identify that this is the revenue from a particular transaction or event, you need to fulfill something that is called the IFRS 15 5-step model,
Okay.
right? The 5-step model. And then fulfilling the 5-step model then technically means that there is a guidelines or there are things that needs to exist or that need to exist for us to be able to say that yes, we can recognize revenue in our book.
Okay.
Otherwise, you cannot recognize revenue. What's the first thing according to IFRS 15? IFRS 15 says that number one thing is we need to ensure that we identify the contract with a customer. So you are a business person, right? Maybe you are offering accountancy services or you are selling goods and services. Let's say you are a trader. You are a trader, right? And then people come to you to buy stuff. When people are coming to you to buy stuff, that is where the whole conversation around revenue starts, right? Because now you are going to be selling something, right? So as you're selling something, there needs to be a contract. Usually when you are selling, the contract that you get to see there is the invoice evidence transaction. And that's why when it asks people what's the difference between invoice and receipt, invoice evidence transaction, while receipt evidence payments, right? So as much as possible, the contract that we are looking at here, in a simple scenario of buying and selling, is your invoice. In a simple scenario of buying and selling is the invoice, right? In a simple scenario of buying and selling. But when it comes to professional services like an auditing firm or an accountancy services, we can have something called engagement letter, right? When it comes to other form of services, in terms of all these new tech businesses and stuff like that, they have something they call contracts or agreements that you sign while you're subscribing to the services, right? So let's say you are using Netflix. Trust me, if you look through Netflix, before you sign up or while you are signing up, you will see where they ask you to agree to something. That is usually where the contract is, right? So you are recognizing you are identifying the contract with a customer. Is there a customer that exists? And why are we having to identify a contract with a customer? Because of fictitious sales or revenue that people can just recognize. Imagine that there was no sales and people are just recognizing revenue based on how they feel.
Okay,
and that is why even as auditor, yes, please go ahead.
Okay, so you mentioned something about you need to recognize a contract, and then you said something about there must be an invoice or maybe some sort of engagement letter, an agreement. The informal sector where you deal with people like over the counter, they just come, I want to buy rice. You measure the cup of rice you give to them. No invoice, no agreement, nothing. Nobody signing anything. If you are a business owner, are you saying that because I don't give out invoice because they don't sign anything, am I not going to recognize those transactions as revenue?
Well, you are still going to recognize those transactions, but now there is a loophole. What is the loophole? The loophole is that anytime that an auditor comes and we need to audit you, you might probably not be able to defend yourself. You might not be able to provide source documents for those transactions. And whatever we decide will stand anywhere in the world. Because you will not be able to prove that you actually sold those things to people.
Yeah, true.
And that is it, right? So that is like the bottleneck there.
So no evidence.
So yeah, exactly. No evidence, and that is it, right? And that's about recognizing revenue, identifying the contract with the customer. The next thing is that we need to identify the performance obligations in the contract. And this is like very, very tricky because many of the questions that you will see on how to recognize revenue, right? On whether or not revenue can be recognized, used to come from here and then the last point. We'll get to why it used to come from here and the last point. Many a times, what decides whether there will be revenue or not is performance obligation. When there is no performance obligation, then there will be no form of revenue. Any other thing will definitely be gifts.
Yeah. Because
there needs to be exchange of values. And where the exchange of value comes in is when the performance obligation is being delivered. Of course, we have other things, which is for a fee or for an agreed amount. And the fee might not necessarily be, monetary consideration. It can be some other consideration or considerations, right? So identify the performance obligations in the contract. For example, still in layman terms, and then the usual small businesses, right? Where we have, say, buying and selling. You get to the pharmacist, you are buying some drugs, and then the next thing is the guy issue you an invoice, right? As you're being issued an invoice and then the drugs is being handed over to you, while you are having that conversation, the performance obligation in that conversation is for the guy to give you those drugs.
Yeah.
That's the performance obligation. Also, taking it to the form of accountancy services or auditing firm, or let's just say general service businesses, right? The performance obligations in those areas is that they need to offer those services to you. Those are the performance, regardless of what you have called the services.
Yeah.
Those are the performance obligation. Then let's go to the tech guys, right? The Netflix, the Amazon, the Google, and all these tech companies that you can think of. their performance obligation now is to, now they call something SaaS, SaaS, software as a service,
Yeah.
SaaS, right? In SaaS business, the performance obligation in SaaS business is for them to make their software platform available for your use.
Yeah.
So that's the performance obligation. So we need to know what value are you deriving, or what values are your customers deriving from you, right? Before we can then say, yeah, we can start thinking that there will be an element of revenue in this particular transaction or event. I'm using transaction and event because when it comes to accounting, everything we are doing from A to Z is accounting for transaction or events.
Yeah.
We are just accounting for things that are happening or that have happened. That is what we are doing, regardless of the shape or form that those things take, right? So we are just accounting for them. And I don't want to use accounting for numbers, because numbers is not what you are accounting for. And that's why they say accounting is the language of business. So moving on, right? Determine, you are going to recognize revenue. If you are going to say something is a business transaction that involves the revenue, there needs to be a transaction price. And now, this price doesn't necessarily have to be monetary in nature. Any form. It can also be exchange of services. Now, you probably need to weigh or know the value or worth of those exchanges, right?
Yeah.
But we know about equity consideration in some of these things, right? We know about and other forms of consideration. And that is why in IFRS 15, they don't say that determine the transaction price or money, or determine they don't use the word money. In fact, they use consideration.
Yeah, consideration. Yeah.
Right? Exactly. And the reason why is because it's not necessarily going to take money form or monetary form. So it can take any forms as agreed between the parties. But we need to determine the transaction price. Again, still like very, very simple form, right? You've gone to the pharmacist, you're buying a drug, and then the next thing is the pharmacist is going to hand over the drug to you, or before even the pharmacist hand over the drugs to you, the guy is already telling you that, you see, this guy, Amatem is 1,000 naira. You see, paracetamol is 200 naira.
Yeah.
Those are the transaction prices. So you need to know the transaction price before you can say you are recognizing revenue. Now that we know the transaction price, there are times where we have a situation where we have bundles where a transaction price is a price for more than one or two service rendering or product offerings. Again, a transaction price is for more than one or two service rendering or product offering, right? In this case, we then need to allocate the transaction price to each performance obligations. To each performance obligation, we need to allocate the transaction price to the performance obligation. And why is this? Is because when you are selling something, let's say you are doing a kind of buy one get one free kind of a thing, right? Then or buy this, get this free, right? If you are buying this guy, right, and you are getting this guy for free, each of these guys are being sold separately, right? Technically, right, you know the price of this guy, you know the price of this guy. The fact that you are bundling them together doesn't mean that we do not have to separate their revenue recognition, because we need to allocate their transaction prices. When it comes to allocating the transaction prices, then we allocate based on what? The prices of each divided by the total price or total amount that we have given out those goods. Right? Am I making sense?
Yeah, you're making sense.
Go ahead.
Okay, so I'm thinking of it from the angle of, at the end of the day, in the income statement, they just one line for revenue. It doesn't matter the breakdown.
Yeah.
So why am I going through the headache of splitting a bundle package into their different prices? I can as well just recognize everything as one, right?
Guess what? The income statement that you mentioned, that one line, you remember that it's a summary. That is the summary, and that is why we have note to the account that eventually shows the breakdown of your revenue. And as a business, for financial analysis purposes, right? You want to know how these things are selling. You want to know whether or not this thing is making sense, whether or not you are losing out on this thing, or you are benefiting from doing it this way, right? So if you are selling this and you are not sure of whether this is driving this, then there can be a big problem.
Okay.
Right? Though I've seen instances where people do not bother to separate them, right?
Yeah.
But when it comes to analysis purposes and stuff like that, you want to know the implications of both. And then also, when you have to recognize your cost of sales.
Yeah, I agree.
I don't know if I'm making sense. When you have to recognize your cost of sales as well, you also want to look at the direct cost of each, because, well, it is still going to, like, at the end of the day, you are going to have a summary.
Yeah.
Like, you are going to have a summary at the end of the day, which is why if somebody wakes up and say, bro, I am not separating these things, I say, no problem. But the reason why it is said to be separated is also for your own benefit, because at the end of the day, if you are going to carry out any form of financial analysis and stuff, it helps your matter.
Okay.
Right? And also for clarity purpose to users of financial information, you also want to let them know how these goods are moving and stuff like that, basically.
Thank you.
Right?
Yeah.
Hello guys, I'm sure you enjoyed the tutorial. So sorry to interrupt. I just wanted to plead with you, Biko, enjoy. I just wanted to plead with you to say that you should please subscribe to our YouTube channel. Subscribe, like, comment, share. These are things that motivate us to do more, and then they are absolutely free for you to do that. The truth is, a lot of effort that go into creating this video, editing it, uploading it, and all of that. All of this was saying that the only way for you to say thank you is just by hitting the subscribe button, liking the video, and commenting. I think that is a fair deal, right? Alright, so please, I'm waiting. Go ahead and comment, go ahead and like, go ahead and subscribe. I'm waiting. Okay, thank you. Let's get right into the tutorial.
So the last part is recognize revenue when a performance obligation is satisfied. Now we see why I say the number 2, that's the requirement 2 in the 5-step model. The number 2 and the last part, which is number 5, are intertwined when it comes to revenue recognition. What do I mean? If there is no performance obligation, there will be no revenue. And even when there is a performance obligation, or when there are performance obligations, right? Revenue is only going to be recognized when those performance obligations are satisfied. And this is like the biggest headache we have out there in today's world. Like the biggest of the biggest. Qudus, IWELABI, when do I have a business, I have a real estate company. How do I recognize revenue? What do I recognize as revenue? Is it the total? So I want to build a house for someone, 25 million. Is it the total 25 million that I'm going to recognize as revenue? This is my percentage. This is this, this is that. This is usually like the biggest headache. When do we recognize revenue? According to IFRS 15, you recognize revenue when you know that you have satisfied or fulfilled the performance obligation. That is when you recognize revenue. If you have 10 performance obligations for a single price, you do not have the right to recognize revenue until you fulfill those 10 performance obligations. When I say you do not have the right to recognize revenue, I mean, now it takes us to the forms of revenue recognition in terms of the input and output model, right?
Okay.
When you have 10 performance obligations to a single price, now you need to recognize the revenue in stage. So when I say you do not have the right to recognize revenue, what do I mean? You do not have the right to recognize the total revenue. You can't recognize the total contractual amount as your revenue until you fulfill all the performance obligation. So this is how it works, right? You have 10 performance obligations that you need to fulfill for a single price. You can either go 2 ways. There is the input method. As you are spending to fulfill that revenue, to fulfill that performance obligation, right, you can recognize revenue of those spend. Then the output method, as you are fulfilling the output method in terms of project outcome, as you are fulfilling the revenue recognition, you probably want to do your percentage to know what percent have you completed that you want to recognize as part of the revenue.
That impute method again.
So impute method is more like, so you are going to render a service to someone, right? And you are going to spend to render those services.
Okay.
So you have 3 million, right? You have this guy, and then you are going to render a service to someone for this amount. And then these things that you are going to render, let's say you are running an errand. Yeah, let's use that as errand. All this errand stuff, right? You are going to run an errand. Probably that is what you do. Like that is your full-time job, and the errand, or let me use delivery. The delivery form is more or less like you also have to incur some costs, right? When we go to construction contracts kind of a thing, you also have to incur some costs before you are able to deliver this service. So you can recognize revenue. Let's say you spend 300,000 naira today out of this 3 million. You can recognize revenue up to the 300,000 naira that you have spent.
This 3 million is the cost price, is the estimated cost price to do that project.
Yeah, exactly.
Okay.
Is the total price of your
Is it correct to say that the input method is using the cost price, the cost of sale to recognize how much, while the output is using the sales, like the sales value of what you've done? Okay.
I mean, in terms of the output and the input, right? So I think I should give another example around that. Right? So the other example is this. Again, like the other guy that is meant to deliver 10 performance obligations. You are meant to deliver on 10 performance obligations, right? Output is that you deliver based on work progress, right? So based on work progress, in terms of, okay, so now you are meant to deliver 3 million. Or let's use construction contract.
Okay, fantastic.
You want to build a 10th floor story building, and then you are done with 2, right? You are done with the second floor.
Okay.
Based on output, you can only do 2/10, right? Yes. Multiply by this guy.
Okay.
Then you recognize your revenue to be this guy.
So
that is based on the output.
Is the sales price now?
Exactly, is the total contractual value.
Okay, all right.
Yeah. Now you see this 3 million, which is like the total, which is the total contractual value. If it is the input method, then it means that based on the amount of money you are spending is how you recognize revenue. You are building 10th floor, right? And you have spent 300,000 up to build the second floor. You can recognize revenue up to this that you have spent.
So to use the
up to the 300,000,
it means you must have an idea of the estimated cost is going to
exactly.
You use to implement the project.
Not just an idea, you need to get it. Okay. You need to get the estimated cost. You need to know the estimated cost of what you have spent. Right?
Okay.
So you recognize revenue. And now the mistakes that you see out there, which is against what IFRS 15 has preached, is that you see people recognizing revenue even when they are on, like as soon as they get the contracts, they just recognize revenue. That is a blunder. They recognize 3 million. That is a blunder. That is wrong. They recognize everything all at once. You do not recognize everything all at once, because that is where the concept of contract liability then comes in. You ask me, what is contract liability, right? Contract liability is that you've received the consideration from here, or you've received the price or consideration to deliver on a performance obligation in advance. Then you have a liability. You have an obligation to deliver on that performance obligation.
Okay.
So in that case, you do not have a revenue. You have a contract liability to the tune of what? Performance obligations that you have delivered on. Then you have revenue. Yeah. So again, now I think sometimes I sit and look about it, or I sit and think about it as head of finance and a young and growing CFO, right? I've worked with a number of businesses, and one of the things that I've seen that kind of cause issues between the finance team and the growth or marketing or sales team is on this revenue recognition.
I can imagine.
Right?
What do you mean by we didn't make any sales this month?
Exactly. And then or what do you mean that is only 600,000 naira that is revenue? But the amount is 3 million. No, it is wrong. It is small.
Yeah.
Blah blah blah. Investor. And most especially with all these startups, right? Let me tell you what the solution has been in recent time. Then we have, and that is where when you see anybody differentiating between sales and revenue, aside from the technical term, people will normally, or some people, most especially the startup guys, we normally differentiate between sales and revenue using the contract amount and the amount earned. What do I mean? This is what I mean, and this is what I've continued to use to settle issues between the two departments in terms of finance or accounting and sales. What do? I report two metrics for them. I said, look here, I understand you, I understand your concern.
Yeah.
Right? If I continue this way, it will mean that your effort is not showing.
True.
Right? But this is what I would do. Because now that we have a number of companies that run subscription business model, right? That means that they are most likely going to be getting a lot of money in advance. Right? As they are getting a lot of money in advance, or as they are closing deals, people can close a deal of 1 year in advance, 2 years in advance.
True.
But when they come to the book, they are just seeing 50,000 naira. They are just mad. What do you mean? How? Explain. So this is what we do. This is what I've been doing. I said, see, in case you see anybody differentiating between sales and revenue, the person is likely saying that when both sales and revenue can be used interchangeably and they mean the same thing. So revenue is now regarded as earned revenue, right?
Yes.
And yeah. So in case you see anybody saying sales and revenue are different, it's just nomenclature, right? And it's probably based on the industry at which the person is playing, right? So, and in those areas, sales and revenues will be the same when the amount of sales that you closed is also the amount of revenue that is earned. That is, as you are closing the deals, you are delivering the complete service.
Yeah.
Now look at me. What do I do in my case? So you've gone out, you've done all the magic, and then you close a deal of 3 million naira. I say, oh, okay, January, let me do January, Feb, right. In January, you've gone out, you do a lot of work, and then you've closed a deal of 3 million naira. I say your sales is this guy.
Okay.
Then your revenue is based on amortization, based on the work done. So your revenue for January could either be this guy or this guy. This guy when it is input method, this guy when it is output method. But don't let us go to input and output. Let's say a subscription based services. Somebody come on 1st of January, pay for a 3 months period. Then the next thing is, I say your sales or your gross sales during that month is 3 million. However, your revenue is 3 million divided by
By
3. And I'm very much happy to help you to amortize this guy and this guy, right?
Yeah.
Yes, exactly. I'll still do I'll kind of design a small deferred revenue table for us to play with eventually. But yeah, that is it. Revenue is recognized when what? The performance obligation is satisfied. That is when you recognize revenue. So regardless of, I know there will still be a lot of questions around when do I recognize revenue? Is it when money is received? Can I recognize revenue when money is received or what? Yeah, and that is IFRS 15 on revenue recognition. Thank you.
Thank you so much. One thing that I actually love so much about this tutorial is the fact that you're not just telling us theory, like things that I can go to Google and just read up. You're telling us the real issues, because this is issues for a lot of people in their everyday life. I mean, you speaking to practical makes it even more interesting. Thank you so much. So I think to buttress the point, we can go into the questions that we have. So we just ask the question and then you give us your insights on it. Okay, guys, thank you all so much for joining and learning up to this point. So we will be taking the question and answer on a different video. We will drop in a different video for that, so that this does not get too long and you just get tired while watching it. So yeah, please check around, subscribe to the channel, turn on the post notification. The video on the questions and answer would be dropped shortly. So make sure that you're glued to the station, okay? Station? Make sure that you're glued to the channel. That's the right word. Make sure you're glued to the channel, and I'll see you in the next one. Okay, bye.